Hi, I'm Andrew Mitchell. In this video, we will be discussing foreign vacation homes held through foreign entities. Say that you visit a foreign country on vacation and you decide to buy a vacation home. As a U.S. citizen, you are taxed in the U.S. on your worldwide income. So if you later decide to sell the property at a gain, you will be taxed on the gain in the U.S. The gain is typically taxed as long-term capital gain, which is generally taxed at lower rates than ordinary income. Since the property is located in another country, you may also owe local country income tax on the gain. However, if you own the property directly, you can generally claim foreign income taxes paid as a credit against your U.S. income tax, thereby avoiding double taxation. In some countries, such as Costa Rica, it's common to own residential real estate through an entity. The U.S. tax rules get complicated when the property is owned through an entity. If the foreign entity has limited liability for its owners and no U.S. tax elections are made, the entity will generally be classified as a corporation for U.S. tax purposes. Holding a vacation home through a foreign corporation has some adverse U.S. tax consequences, including typically ordinary income rather than capital gains if the foreign corporation sells the property. In addition, there's no ability for an individual to claim foreign income taxes paid by a foreign corporation as credits against the individual's U.S. tax. The IRS has a list of foreign entities that must be treated as corporations for U.S. tax purposes. These are referred to as per se corporations. For example, an SA in Costa Rica is on the per se corporation list, and it must be treated as a corporation for U.S. tax purposes. In contrast, an SRL in Costa Rica is not on the per se corporation list and is not required to be treated as a corporation for U.S. tax purposes. However, if no election is made for the SRL, it will default to be treated as, or automatically be treated as, a corporation for U.S. tax purposes because it provides limited liability to its owners. If a foreign entity with limited liability is not on the per se corporation list, the owners of the entity can elect to treat it for U.S. tax purposes as a disregarded entity if it has one owner and as a partnership if it has multiple owners. This entity classification election is sometimes called a check-the-box election, and it is made on IRS Form 8832. To make such an election for a foreign entity, it is required that the foreign entity have a U.S. employer identification number. In the disregarded entity context, the U.S. citizen owner is treated as directly owning the assets of the entity. That is, the entity is disregarded. Therefore, any gains recognized by the entity and any foreign income taxes paid by the entity are treated as being recognized by or paid by the U.S. citizen owner. If the check-the-box election is made effective on the date the foreign entity is formed, then it is an initial classification. An initial entity classification election must generally be made within 75 days of the entity being formed. An initial classification of an entity is not a change in the classification of the entity. This is important. Changes in classification of an entity can trigger gains. A change in the classification of an entity from a corporation to a disregarded entity or to a partnership is generally treated as a taxable liquidation of the corporation for U.S. tax purposes, triggering gain to both the corporation and to its shareholders. In general, a check-the-box election cannot be made retroactive more than 75 days prior to the date the election is filed with the IRS. Revenue Procedure 2009-41 provides relief for certain late check-the-box elections. If the late relief of this revenue procedure does not apply, a taxpayer may be able to request late relief by submitting a private letter ruling with the IRS. However, IRS fees to submit a private letter ruling and tax advisor costs to prepare a private letter ruling submission can be significant. These are complicated rules, and this is just a short video discussing a few of the considerations. If you need advice in this area, you should contact a U.S. tax advisor. Making a check-the-box election is not always the best approach. For example, if you continue to live in the United States and you take a mortgage from a foreign bank to purchase a foreign vacation home, making a check-the-box election to treat the foreign entity as a disregarded entity could create some unintended U.S. tax costs. It is important to understand all of the facts and circumstances prior to making any decision. Thank you for watching. I hope you enjoyed the video.